Good morning, everyone. Thank you for coming to today's spotlight session. Today we have one of our new agents, Mr. Dave Nelson, who's going to give us a presentation on creative finance. This was something that when he first joined, we had a conversation about, and I was just very intrigued by it because it's, different ways to finance deals that we just didn't think about. So I won't get too much into it because I have no idea what any of this is about. So I'm going to let Dave go ahead and take it away. Dave, it's all yours. Thanks for coming.
Having me, and thank you for attending in person, and for whoever is out there watching on Zoom, thank you so much for taking the time here for me today. As Lawrence mentioned, I am a new agent here at KW Cornerstone as of literally just a couple days ago, I guess, officially. Uh, get that. Yeah, so just earlier this week, been working with the onboarding team to get on everything. So I am a fresh new agent. So just that, for everyone that I've already spoken to that's helped welcome me here so far, just thank you for that. And I'm very excited to be here as I believe my relationship here with Keller Williams Cornerstone is going to be monumental to my own career and my own company. And also my goal is to try to help educate and work with as many people within this brokerage as I can to help not only myself, obviously, but everyone here close more deals and make more money at the end of the day. And that is something that I have found that creative finance is really a very unique solution to get deals that otherwise would not be able to close conventionally, could actually eventually get them to close. That's one of the biggest. If I had to give a definition of creative finance, it's basically any deal that a real estate transaction where property can be transferred in a non-conventional way with non-conventional financing. So that being said, I already asked you, Jim and Mia, do you guys have any experience at all with creative finance? Do you know anything about it? Have you heard about it? And do you have any impressions of it? Anything that you want to start with and in that perspective?
Not really.
Not really. Okay.
I followed Pace Morby for a while, so
Okay.
I kind of understand it. I've tried to do a couple offers, some too, but they didn't go through. But
Yeah.
it's interesting stuff.
All right. For those of you on the Zoom that might not have been able to hear, Mia was talking about how she has watched some videos on Pace 2, Pace Morby, who's I got a company named Sub 2. He's kind of the godfather of Subject 2. Louder. He's kind of the godfather of Subject 2, which is one section of creative financing. And it is a great way if you have a client who is either going into pre-foreclosure, if you have a seller that's going into pre-foreclosure, that might be a great scenario to take a look at with them. But at the end of the day, looking at this from, let's just, for lack of better terms, from a normal realtor perspective, if I was working either as a listing agent or a buyer's agent, for me personally, I feel that I would be doing them an injustice if I didn't at least, first off, do a quick analysis of the subject property to see if creative finance might be a viable option for those people. And then if it is, at least have a conversation with them to see if it's something that they might be into. If it's something that interests them, then you have automatically, if you're talking to a seller, you have automatically opened up a massive number of additional buyers in a potential buyer's pool than you would from a conventional transaction. So from a listing perspective and doing listing presentations, if you do a couple minutes of due diligence beforehand to take a look at the viability of creative finance, then you can put yourself in a position where you can have a multifaceted listing presentation and option scenario for the potential buyers for that property. Because if you just look at a single family residence and think, well, the only option is to find someone who wants to come here and live in this house, be owner occupant, and that's it. Well, you are limiting yourself to buyers that are in that scenario and that scenario only. So that being said, there are two, again, forms of creative finance that I'd at least want to give some introductory type knowledge to you guys on. And then we can kind of branch out and go from there and how it might help you from a agent's perspective. So just to hit the next slide here. So just a little bit on myself. I've been in real estate myself for over 12 years, high level, national level sales for 17 years. I've closed well over $60 million of business between my real estate businesses and my W-2 sales careers that I've been in since I graduated from college in 2008 from Clemson University. So I do consider myself to be a high level salesperson, and that combined with the knowledge that I've gained in real estate has really transformed what has now been created as my real estate investment firm to be able to take advantage of real estate and hopefully put me and my family on a path towards generational wealth with my own investment portfolio of my company. So I'll ask, I know I don't have a huge audience to ask, but I'll ask you guys a couple questions. Have you guys ever lost any deals due to financing falling through? Has that ever happened?
Yes.
It has?
Yeah.
Where someone didn't get approved for a loan, let's say, or a seller wanted more than the bank was willing to lend. Those type of scenarios?
Yes. Scenario as well as scenario where condo was not approved, the loan, the lender said, I cannot give the financing, and then the deal fall apart.
Maybe also the appraisal, if a property doesn't appraise for a certain amount, and then a negotiation could fall through in that type of a scenario as well, right? So, financing falling through is something that I think is very common for a lot of agents, mainly because a lot of buyers and sellers, especially buyers, obviously, probably are not going through the right channels to get proper pre-approvals and know exactly what they can afford. Or they're working with an institution that claims to be a high-level institution that can provide the financing and then ends up not being able to at the end of the day. That being said, for any deal that you might have where, especially recently, if financing fell through, or if you have listings that are on the market for a long period of time, or if you have someone who's desperate to get out of a situation because they're underwater on their house, they owe more than what the house is worth, let's say. Any scenario like that could be a very, very viable scenario for creative finance that could be a win-win for both sides. Okay. So let's give an example based off of one of those examples. So let's say a listing that has had a very long extended days on market. So let's say you have something that's been on the market for 6 months. You have a seller who, is in place, needs to sell the house. What is very likely the reason for why that house hasn't sold? In your opinion, if a house is on the market for a long time, what is very likely the reason?
Price is high.
The price, right? The price is too high. The seller's not willing to go down on the price, right? Would you agree with the statement that 100% of sellers overvalue their own property?
Yes.
Yes, right? 100%, 110%, right? Okay, so knowing that going in and doing all you can to say, hey, listen, the market dictates the price. I know you said you think it's worth $500,000. I think it's worth 400 grand. The market dictates that, though. That's not Dave saying that. There's 3 comps right here: 390, 405, 400. Your house is worth 400, right? But for someone who says, I want 500 for my house, and that's all I'll take, that house might sit on the market for 6 months, 9 months, 12 months, right? So Let's say that that same person has owned that house for 30, 40 years. And the reason that they're so adamant about getting their price is because they care so much about their property. So they want to get the most value for it, right? Well, there might be a way, if they're open to it, for them to get their $500,000 or maybe even more. However, it would come with different terms and parameters than a conventional sale would come with. Because trying to ask a buyer to pay $500,000 for a $400,000 house is going to be a very difficult sell to the buyers for obvious reasons, right? So hypothetically, what if you were to go to that seller and say, hey, listen, I know you want 5. The house is worth 4. Okay. Here's a way that I can get you 5. What if I found you someone that would be willing to give you, let's say, $50,000 in your cash in your pocket today? And then set up a payment term where you will get a monthly payment for the next 3, 4, 5 years, whatever the term might be. And over the course of that term, and then at the end of that term with one lump sum payment, you will make $500,000, or maybe let's say $550,000. Is that something that you might consider to make sure that you get your money? If you have someone that says, no, I want the money today, okay, then we're right back in the same situation. Good luck finding a buyer at 500 for something that's worth 4, okay? But if someone's open to how that might look, then what that does is it opens up to the property to a potential investor who would be willing to, you notice the numbers I said, $50,000, right? So that's a $10,000 down payment. If an investor were to go to like this property and say, I want to buy this property as an investment. If they were to go to the bank for an investor loan, DSCR is looking at 20 to 25% down. Let's be conservative. Or let's just be on the better side and say 20%. Okay. You could basically negotiate terms with the seller so the seller becomes the bank. And that's why they call it seller financing. The seller is financing the property back to the buyer over a certain period of time. What are we creating? We are creating a mortgage. Who is not involved?
The bank.
The bank. Okay. So seller wants 500. You say, I can get you 500. In fact, I could get you 550, but it's going to take me 5 years to get it to you. And this is why. For an investor, for it to make sense for an investor to buy this property, they need to beat the bank and they need to make it on terms that they'll cash flow. So 10% down payment, 50 grand. We've beat the bank by giving half the down payment that they would have had to give if they gave 20. They would have had to give 100. Now they're giving 50, right?
Yeah.
On top of that, whatever monthly payment that you negotiate with this seller, it would be with a applicable interest rate that would also be lower than your standard bank would give.
Yeah.
So right now, let's say the bank is offering 6%. You might find 5s somewhere, right? If I was in here 6 months ago, it might have been 8%, right? But either way, let's just say it's 6%. Well, you could go to the seller and say, okay, so this is what we're going to do. We're going to set up a monthly payment structure where you're going to get this number. That number is going to have 3% of interest in it. So your down payment plus this monthly payment with 3% of interest over a 5-year term will add up to be this number. That number minus your total purchase price, which would be 500, plus the additional interest that you make could be 525, 550, is how you get that 500 to 550 over the term. At the end of the term, there is a balloon payment. That's what that's called, where you get your lump sum payment. In this scenario, you get your lump sum payment at the end of the term instead of the beginning of the term. So what would this also require? This would require a seller that does not need $500,000, 500 grand today for something in their life, right? But if someone doesn't need all of the money right now, they can effectively, and this is my line of selling this to the sellers, let's turn your property into an investment property. I have a way now. This house is really worth 400. If I can get you 550 in 5 years, $150,000 divided by
Oh, it
5,
doesn't work that way.
I've basically turned your house into an investment property that's going to return you $30,000 a
go out and
year
come
over
out.
the next 5 years, and you do nothing for the investment. You're not the landlord. You're not responsible for the tenant. You're not responsible for the maintenance of the property. The deed does transfer, so you don't own the property, but you're the bank. You're financing the property. So you go off and do whatever you're going to do with your 50 grand. You get your monthly payment in from the buyer, and then your lump sum payment at the end. This also, if this is an investment property that's being sold and not someone's personal residence, this can also be a big tax advantage as well by deferring potential 1031 exchange type money. Capital gains taxes are now, instead of, if that was an investment property in this example, well, now you have 500 grand that you're going to pay 30.5% in New Jersey on as capital gains tax to sell that property for 500 grand straight up. If you do it this way, you'll pay 30% on 50 grand. You'll pay some income tax for 60 months along the term. And then you'll pay 30% on the lump sum payment in 5 years. But you very likely had someone working with you in the transaction that's going to turn that into a 1031 for you, and you're not going to pay taxes at all. The point being, this is a creative way to get this seller what they really want, 500 grand or more. And they are turning their property into an investment property by doing that.
Do you have the numbers illustration for this example?
Sure. So this is, oh, hold on. Let me, sorry, give me 1 second. So this example that's on the screen is not going to be the same numbers as I just gave,
That's fine. Give the illustration.
but it at least gives you a bit of an illustration, right?
We got a question online. For a seller financing, the property is supposed to be fully paid by seller, or seller can continue paying their mortgage.
So for seller financing, this is a situation where the property is owned free and clear. There is no mortgage left. Or there's such a small amount of mortgage that the down payment would cover the existing debt. First bank gets paid off and the rest gets financed by the seller. When it was brought up about subject to, that is a scenario where there is still a mortgage involved. So I could do that next. So creative finance, if you look at it kind of as a pyramid, creative finance is the general term for this side of the industry. And the two main branches of it are subject to and seller financing. And creative finance works best when the debt, you can either look at it as debt or equity. The debt or equity are at either sides of the extremes. So if there is a property that is underwater, let's say someone bought their house with low interest rates and then interest rates went up, or high interest rates and then they lost their job. They're in an area where their house depreciated in value. If the debt on a property is close to or over the property's value, they are underwater, and that is not a good situation for them for obvious reasons. Or let's say someone bought their house and, like I said, maybe they lost their job. They do not have the capability to keep paying their mortgage. In that scenario, subject to might be a viable creative finance solution. The example I just gave was seller financing. So I'll kind of finish up seller financing and then I'll touch a little bit on sub 2 if that works. Okay. So yeah, and by the way, I can email this out to everybody so you have this as well. And if you want to learn more about this, you and I can schedule a call, a meeting, whatever, and I can go into this in greater detail. But this is an example that I put on here. if something was 300 grand, and again, there was a $10,000 down payment and 90,000 of it was seller financed, the buyer's putting 30 grand down. Again, if this was an investment property with a DSCR loan, 20% minimum, this number would be 60, if not 70%, or 60 or 70 grand.
Yeah.
But instead it's 30. All right. The seller carry or the seller finance note is 270,000, which is 300 minus 30. Let's say it's at 3%. Other than an FHA loan, is anyone here going to a bank and getting a loan right now for 3%?
No.
No one is.
Would the seller
Right.
agree to 3% when the market rate is like 6%?
Well, if in this scenario, the seller, we are trying to get the seller as much additional value as we can. Remember, it's not on this, but let's assume this house is actually worth $250,000, $225,000. But this seller wants 300.
Yeah.
So they are already basically getting $50,000 to $75,000 of interest by someone giving them a purchase price of 300 grand when that house is not worth 300 grand. Okay.
Yeah.
So there's interest built in there theoretically.
Mhm.
And then again, we are creating our own mortgage when we do a seller financing note. So the bank's terms, the Fed, the IRS, all of that, as long as you are above the IRS's minimum threshold, which is, just under 2% of an interest rate for doing private loans, then you can come up with whatever interest rate you want. So to your point, maybe they don't, maybe they want more interest, but if they want more interest, then it doesn't make sense for the investor at that point.
Yeah.
They might as well just go get a DSCR loan at 6%.
Yeah.
You know what I mean?
Yeah.
So this is a give and take where it has to make sense for both sides. So are they going to get less interest paid to them than they would if they were an actual bank? Yes, but they're not an actual bank. They're a regular person, right? What they're also getting is a higher purchase price than what they deserve. So they are getting additional money on the purchase price. They're getting interest on top of that. And they're getting the tax savings of not doing this all in one transaction. Okay. What the buyer is getting is into a property at 10%, a 3% interest note that they cannot get from the bank. And they're getting a property that after 5 years, they're going to have some options on what they can do with this property. Because the 30,000 that goes to the seller up front, plus the monthly payments over the course of the term, the remainder of that is due. It's called a balloon payment.
Yeah.
The remainder of that is due at the end of the term,
Yeah.
right? So the buyer has options. They can, because they at the execution of this, they receive the deed. They're the owner.
Yeah.
They can sell the property. We now have 5 years of appreciation on this property. So that property that might be worth 250 grand today, let's say, is worth 325 in 5 years.
Mhm.
But we've already paid down 270 minus all the payments. Let's say it's 200 grand. So they could theoretically sell the house for 325, pay the remaining 200 balloon payment back to the seller. So the seller is now fully reimbursed with everything that they were promised.
Yeah.
And the buyer got monthly cash flow every month. So a little bit of income every month,
Mhm.
a cash payment at the end, and they're out buying another property. Or if they have enough equity in the property, they could take that balloon payment and go to a bank and say, I owe this guy $200,000 on a seller financing note that I did with them.
Mhm.
But the property is worth 325. That debt to loan ratio is 60-ish%, right?
Mhm.
A bank will give you that 200 because the property is worth 325. And now after 5 years, you now have a new mortgage with a bank. And you would only do this if that payment is going to be low enough that the rent that you get on this property, you're still cash flowing. But that is a way that you keep this in your portfolio. You keep getting the income over and over and over again. And whenever you want to sell it, you could sell it, but you will also receive a cash proceeds payout when you do eventually sell. Okay?
What if the buyer defaults, and you foreclose on them.
Yes, absolutely. So the buyer in this scenario, the 10% that the buyer is giving down is in cash. It's not a loan, meaning that the seller finance note would be considered a first position lien mortgage, right?
Mhm.
If you were to do this deal, you would also include with the PSA what's called a secured promissory note. Familiar with that? You guys are both shaking your heads, so you're okay. So the secured promissory note gives the seller the ability to foreclose on that note in the event that the buyer defaults, stops making payments. And most of the deals that I've done, it's one payment. That buyer misses one payment, one form, apply for default, and bam, you're right. The deed of that property gets transferred back to you. Now, there's no debt on the property. Technically, there was debt to the buyer, but there's no debt on the property. There's no mortgage on the property from a bank. This scenario that you just asked about is a home run scenario for the seller. The seller should pray that the buyer defaults. Why? Because in the terms of the agreement and on the promissory note, what will be said, and this is standard practice for seller financing loans, is the seller keeps the down payment, keeps every monthly payment that they got throughout the process, and they receive the deed of the property back unencumbered. So they theoretically could take all that money. There's also a factor of appreciation. Let's say it took 3 years and then they defaulted, right? So now there's 3 years of appreciation on this property as well. That is a number that can't be factored what the number would be, but it is a number that seller could theoretically sell the property again twice, keep the proceeds from the first sale, and then sell the property again with appreciation. And also in that scenario, that buyer, if they ever plan on investing in real estate again, it'll be a long time before they're able to, because this will, are we cursing friendly in this office, by the way? For the most part, somewhat. Okay. This will seriously F their credit if they were to do this. So we don't, if we're buyers, we do not want this to happen. Okay. As a seller, that is your protection that this can go through, this can happen, you can get paid, this can be an investment. And in the event that the buyer doesn't hold up their end of the bargain, they still actually get the most benefit out of that happening. But great question. Go ahead, Mia.
Could the buyer put a wrap on that first mortgage
Sure.
and resell it?
Theoretically, they could, but well, in this scenario, no. But there is a wraparound type scenario that is possible. It just wouldn't be used on this specific thing. For this talk, I kind of figured I'd be talking to the vast majority of people that are either don't know anything about creative finance, are not well versed in it, and don't really use it in their day to day. So I kind of made this like a 101 type of thing, right? A wraparound. The fact that you even know about that means that I want to talk to you individually at some point, because you at least are a little bit more advanced than your average real estate agent, with all due respect to everyone else. But yeah, it gets creative financing. Yeah, but Pace Morby, right? If you've watched any videos on him, he evolved from doing just sub 2 mortgages to seller finance, wraparound deals, and then eventually capital stacking and debt layering things on commercial real estate. That's something that I'm currently doing too, but it is very, very complex. This is the beginning stages of seller financing and sub 2. And really, I guess the main point I wanted to get across by having this first spotlight session is that as agents, if you're a listing agent or a buyer's agent, having the conversation with your clients to at least educate them on creative finance, first step, you guys should all be educated on it, because it's a big part of the industry. Like it or not, it is a large part of the industry because of so many constraints. Again, interest rates have come down, but the interest rate being as high as it's been over the last few years, real estate spiking at an appreciation level that is not going at the same level as people's salaries are going, younger people not getting qualified for homes, the housing crisis in this country. There are many reasons why creative finance has become a much more prevalent form of the transfer of property. So you guys would be well served to, at nothing else, just become knowledgeable on creative finance, so you're aware that it's an option, so that if you do find yourself either in a difficult scenario where you can't figure out a way to sell a property, can't figure out a way to get your buyers qualified for a property, anything like that, creative finance could possibly be a solution that turns a dead deal into a sold deal. So, Mia, great question, but it's an in-depth answer.
So if aren't the seller okay to do seller financing, because they also have the fear it takes 2 to 3 years to foreclose somebody in New Jersey with all these complexities? Would seller be okay to do seller finance?
Yeah, so New Jersey, let's just be quite frank, right? New Jersey is not necessarily an investor or a landlord friendly state, right? It's a tenant friendly state. To your point, it takes a long time to evict tenants. It does not take nearly as long to foreclose on a deal like this if you have a secured promissory note in the agreement. I'm not saying it's going to happen overnight, but if they miss a payment, that form gets put in, you get a court date, and that deed comes back to you. So is it a possible risk, we'll call it, or something to maybe be considered in the deal? Sure. But we're also working at trying to get somebody $200,000 more for their property than it's valued at. There will be some inherent risk, I guess, that will come with that, admittingly so. Conventional deal, if this person right here said, you know what, I'll take 225 cash or conventional, it could be a clean, easy deal with no risk at all. If my first example, if that guy said, you know what, I'll take 400, clean and easy, cash, conventional, no risk at all. Except maybe you have the risk of financing falling through and wasting your time, right? But if the deal goes through, no necessary like inherent risk because you're out of the property and you're done. But if you want to be someone who's savvy and turn your property into an investment property, make maybe $30,000 a year over 5 years, like my first example, and make an extra 150 grand on the sale of your property, well, this is a way that you can do it. And yes, you will inherit some small risks going down that path that might take up some of your time, energy, and money in the event that something goes wrong. Let's put it that way. Because it is a 5-year commitment that you're making with somebody. But in that process, if you found someone who wanted to offer you as a seller, if you found a buyer who wanted to offer you a seller finance deal, if you're represented by an agent, if I was representing you and you were the seller, then I would go to either them or their agent and I would say, okay, I want to see obviously a legitimate proof of funds showing that not only can you pay the down payment, but I want to see your portfolio of real estate owned. Show me what you've got going on. Show me that you have the ability to pay either the full purchase price or you have the ability to get credit to a certain level that'll make me feel comfortable on this deal. What other collateral might you have somewhere else? Do you own another business you could borrow against or property that you could borrow against? I would do my best if I was representing the seller on the front end to mitigate their risk as much as I possibly could by vetting the buyer and making sure that the contract that's put into place for this agreement is as ironclad as possible.
Yeah.
Fair enough? Yeah. All right. So
Dave, I have a
if that's
question.
good
This
for
is Ash
that,
here.
what I can do is I can hop into, and this I think might have been the previous slide where, so this right here, to whoever was asking about an existing mortgage earlier, and I mentioned about subject to, if you're still on the call, If we're at the pyramid and we're looking at someone who owns their property outright or has very, very little debt, or they have a high equity scenario, seller financing is the route that you could potentially go. The other end of the spectrum is high debt, low equity, someone who's underwater, someone who bought a property that they can't afford, someone who bought a property that they could afford, but then they lost their job, someone who bought a property and very shortly afterwards there was depreciation in their area for whatever reason, a natural disaster, or it became a crime infested area, or whatever it might be. The value of their property goes down, but their debt stays the same as it was when they bought the house. It's on that same trajectory. Depending on what that interest rate is and what that monthly payment is on that debt, you could theoretically have someone take that debt over for you. So basically, it's getting it off. You have a problem. The solution is getting it off your shoulders. And if there's a scenario where we can do that, and we could also get that seller a couple bucks in their pocket to say, hey, we're going to let you walk away from this. This property is a problem for you right now. We're going to let you walk away from the property unencumbered, and we'll put $5 grand in your pocket, 10 grand, 50 grand, whatever makes sense. We'll put that in your pocket and we'll just take over the property. This debt that you can't pay, we'll take care of it. The foreclosure you're about to go under, we will stop it from happening. Now, the only way that that would be possible is that if that debt and the monthly payment on that debt, whatever the rent that you can get for that property, because remember, this is an investor type thing. So whatever rent you could get from that property would cover not just that loan payment, but the operating expenses that would come with having an investment property management, maintenance, so on and so forth. But if that analysis is done and those numbers work out, then you can do this type of an agreement, which is a purchase. It's called sub 2 or subject to. The full line is subject to the underlying debt on the property. There'd be a special addendum that states that. Now, in order to do this, and I prefer seller financing far more myself personally than subject to, because in order to do this, the seller, their name does have to stay on the mortgage. Because remember, the bank pre-approved them and then approved them, gave them the loan, ran their credit, got their W-2s, got their paychecks. Now someone else is going to take it over, and the bank knows nothing about this person. The bank didn't check their credit. The bank didn't get their paychecks, right? So what the seller would do is they would put that property into a trust and then give the controlling purchasing interest of that trust to the buyer. The buyer then funds the trust pays the mortgage. The bank, people put properties in trust all the time for all different types of reasons. So this is not like suspicious at all for a bank to have someone put their property in a trust. So if someone else then is funding that trust and then making those payments, bank never, has any reason to question it. And that investor gets a cash flowing asset that they very likely had to pay very little money to get into. Okay, so that's kind of how subject to works. And to the end of the term, there will be the seller's name on the mortgage. And as long as the buyer remains paying those monthly payments, then there will be no issue. There's a little bit more of an in-depth and detailed and riskier default clause in the event the buyer stops paying their payments on that. So again, I'm not a huge fan of subject to because it does add increased risk to the seller, but some sellers don't have a choice. And if it's a choice between doing this or going into foreclosure, this is a better option for them, for sure.
Dave. Question online.
Yeah.
It says, who's running the transaction? What is the listing agent job or duty on this?
Who's running the transaction? Okay, so you're listening right now to a licensed agent who has become an expert in this creative finance field, which really, for the most part, has been a off-market type of transaction exchange program for decades, right? And agents like me actually have a term. We're called unicorn agents because for the most part, real estate agents are realtors and work on market. And then you have a bunch of off market people doing creative finance and off market type stuff, right? In my scenario, I'm looking to do creative finance on market deals. There's nothing illegal about any of this, by the way. That's one misconception, is that this is either illegal or unethical to some degree. And I'm here to tell you that it is neither. And I'm not compromising my license by getting in these transactions. And neither would any of you guys. And again, with the right contracts and everything being disclosed, there is nothing illegal about anything involving creative finance. But as in regards to who's running the transaction, it would very likely be whoever is representing the buyer or the buyer themselves. You don't need to be a real estate agent to go to the owner of a property and say, hey, I'll give you this offer for your property. There's no rule saying that a realtor has to be involved in a real estate transaction, that a lawyer has to be involved, so two United States citizens can come to terms on a purchase and sale and contract agreement for one thing that somebody owns and one thing that somebody wants to buy, and whatever those terms are, as long as they both sign, it's legal, right? So a buyer of property that is familiar with creative financing, even if they are not a licensed real estate agent, could be the one, to answer this question, running the transaction or going to the seller and saying, here's what I'll offer you. I'll offer you this down payment. I'll offer you this monthly payment. And if you want to be legitimate, at the end of the day, you should at least have a lawyer that is drawing up these contracts, right? Because you still need to close with a title company. So a lot of these buyers, they will have a lawyer draft up a boilerplate contract for them. They fill out the terms of the agreements, give it to a seller. If the seller agrees, gives it to the title company, and then the title company would still then do their requisite process of a title and municipal search and closing on the property. But there's also nothing to be said against the fact that a buyer can go on Microsoft Word and say, I'm buying this property at this address. I'm going to give this purchase price, this down payment. This is the terms, blah, 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 blah. I'm signing here. Someone else is signing there, and send that to a title company. Title companies may not care about the depth of a contract as long as all parties are consenting and all parties have agreed to the terms. But in the real world, you'd want to have some sort of a legal instrument in place for your PSA. It's probably not going to be your standard, let's say, NJAR document, right? Because there might be additional clauses put in to make the creative finance deal work that would not be on your standard typical realtor contract. So a lot of times it's the buyer that is controlling, to whoever answers that. I'm looking at my laptop now. A lot of times it would be the buyer or the buyer's agent that would be handling the transaction. And depending on whether or not the seller of the property has that property on market or not, they also might have their own representation, and the two realtors would work together. And quite frankly, that's the scenario that I work under 90% of the time. Now, most of the time I'm doing this type of stuff in commercial real estate. So there's almost always, I have my own attorney that I work with. And then there's also almost always a seller's agent and a seller's attorney. And the four of us are all working together with the seller and buyer to get a transaction agreed upon and then eventually closed. But there's also a lot of quick cash transactions that are done off market, and then quick seller finance transactions that are done off market, that a title company, once again, does not need a realtor necessarily to be involved, does not necessarily need an attorney to be involved. They could come to an agreement, buyer and seller, with each other. And this is actually something that I've come to find out is one of the reasons why most realtors, and I'll say with all due respect again, because I know everyone on this call is a licensed agent, but remember, so am I. Most realtors look at either creative finance, seller finance, sub two, or wholesaling properties as this is going off market and I'm getting cut out of the deal, right? And in all the transactions I closed last year, if the sellers either had an agent and it was on market, or there was even someone that was advising them at like this is my real estate agent. I don't have it listed right now, but they're gonna handle the communication and transaction for me. They're gonna be my point of contact and my reference. The first thing that I would tell that person, even if it was going to be a off-market deal, is your commission will be paid no matter what it is you've agreed to with them. Is it 2%, 2.5%, 3%, whatever it is? Your commission will be paid first in this transaction out of the down payment before anyone else gets paid, even if it's not an on-market transaction. That way, the realtor knows that they are not getting cut out of this deal. They're actually an integral part of the deal, a necessary part of the deal in this case, and they will get taken care of monetarily, and they will be kept in the loop on everything involving the transaction. So that's something good to know because it's a very common misconception for realtors in general.
What if at the end of the 5 years, the buyer cannot come up with the lump sum? What happens at that point?
So we're betting on a couple things. We're betting on the appreciation first and foremost. The deal should be structured in the beginning so that that down payment is creating equity from day one, right? So even in that other scenario with 10% down, there's theoretically 10% equity, right? There's 90% debt on the property. And let's just say, this is obviously going to be case by case specific for everywhere in the country. Because by the way, you guys can be licensed agents in New Jersey and you guys can do these deals if you want to be buyers or even coordinate, like middleman the transaction, find a prospective property that'd be good for this, find an investor and connect the dots. You guys can do this anywhere in the country legally, even if it's, so just note that that's a possibility. But you'd want to structure the deal from the beginning so that first off, you're creating equity from day one. Depending on the market that you're in, you'd want to calculate what is the average appreciation for this asset class. If it's a single family residence, cool. If it's a mixed use property, if it's a RV park, if it's a car wash, whatever it is in this area. So right now I'm under contract on a $4 million commercial deal in Wildwood. In Wildwood, they have a much different appreciation rate because it's a very unique spot of the state and the country, right? So we are in a scenario where we can take additional debt on this deal because we know that the appreciation over the course of this deal is going to be so much substantially higher than your typical single family house in the middle of nowhere that we're building in a safeguard for the end of the term. But to answer your question, there needs to be a amount of equity, and then remember the monthly payment that you get for 60 months, let's say if it's a 5-year deal, is chopping away at that as well. Mm-hmm. And then the appreciation is also moving. And I have a calculator that I could show you to kind of see how, like, if purchase price is this, down payment's this, monthly payment's this, what would the appreciation be and what would the balloon payment be versus the projected value of that property with X amount of appreciation. And my goal would always be to have that be somewhere around 60%. Most banks will refi a balloon at 70% DSCR or debt to loan ratio. Some are strict and will do 60. So I try to be conservative and safe and structure the deal to be at 60%. But to your point, if there is no equity, that is I guess, an inherent risk in this as well. And the focus would be to structure the deal appropriately so that whether it's banking on the appreciation or the buyer of the property will promise and put in writing to do certain renovations, enhancements, or whatever to increase the value of the property through the 5 years, that as well will get it to a point where the market value should very at the very least be higher than what the balloon payment is, so they could sell the property, get the seller their balloon payment, and keep the proceeds.
So their option is, if they can't come up with the balloon, they can just sell it to get that balloon.
Yeah. So on the, I think it was this one right here. So balloon term, after 5 years, refi or sell is theoretically the two options. You could sell the property because you own the property, you get the deed when you buy it. You could sell the property, pay off the balloon, keep the proceeds. If you can refi, first off, if you can refi, and second off, if you do refi and that monthly payment still gives you the ability to cash flow with the tenants that you put in that place, then it's probably in your best interest to refi. Because now I'm keeping this property in my portfolio, my investment portfolio, and I can keep it for another 2 years, 3 years, 5 years, 10 years until the next COVID hits and it spikes up 200%, and then sell it, like whatever might happen. As long as you're cash flowing, you can theoretically keep it in your portfolio and refi and hold it and have it be a buy and hold. And most people that I've come across that do stuff like this, they want it to be buy and hold. They want to refi.
Sure.
So they will intentionally structure it from the beginning, maybe even sometimes with larger down payments to create the equity from the start so that they have a better chance of refining at the end of the balloon. But you always do have the option to just sell the property and then pay those proceeds back.
Are you putting it in a trust to avoid the mortgage company becoming privy to whatever agreement that you have with the seller?
If you're doing the subject to agreement, so again, the low equity, high debt, underwater scenario, where someone has a mortgage that maybe they got in 2021 at 3%. But now 5 years later, they, whatever happened and they got to sell their property and they have very little equity in it. Well, they have a very attractive loan. Once again, a loan that we cannot go to the bank and get 3% right now. So yes, they would put it into the trust and then give controlling interest of that trust to the buyer so that the buyer could fund the trust and the trust pays the mortgage. Okay. The reason that I said that I don't like really getting involved in these type of deals is because technically what you're saying is true. The bank does not know that seller, the one that they put the mortgage out to, is not making the payments. The bank does not know that. I know you said hiding and there's nothing illegal about, first off, creating a trust, and then second off, letting someone else be a beneficiary of that trust. And then there's nothing illegal. Like if you own a house right now and I said, hey, I like you so much, I'm going to pay your mortgage for you for the next year. And I just sent that money to you and you had it in a trust. It's technically not illegal. Could you look at it as maybe unethical because it's hiding it from the bank? Maybe a little bit. And that's why I don't really do a whole lot in sub 2. But it is a way to protect from foreclosure, and there's a legal way to do it.
To avoid the
Do on sale clause, exactly. Yes. And that's how Pace Morby started his business, and he evolved. I mean, he's now 9-figure, probably getting close to a 10-figure business at this point. But he does so much more in seller finance and commercial seller finance, because sub 2 comes with more risks than the other forms do. And I don't think anyone wants to necessarily be in more higher risk scenarios. If there's an opportunity to make a lot more money, like high risk, high reward, maybe, but this is like the same reward, but higher risk, might as well go after the seller financing. I'm just trying to educate, I guess, you guys and everyone that I'm talking to on the fact that this exists, it's legal, it's ethical, and it is a way that you could theoretically help save someone, especially if they're about to get foreclosed on.
Dave, this is Ash.
Seller financing, you're paying 50,000 more for the property, but you're getting very low interest rates. So you are also paying much faster the principal that you own, right? And then after 5 years, it either appreciates or even get too close to it that you can refinance and have the tenant pay for it.
In essence, everything you said, yes, is correct. And if you want me to take it a step further, and this might turn your brain into a pretzel, but another thing you can do is instead of offering principal plus interest payments, you offer interest only payments. That way, it's a lower monthly payment to the seller so that you cash flow more, but they get a larger lump sum because nothing touches their principal stays there. So you can do interest only payments and then a separate interest number on the balloon that's deferred to the balloon, but it's on the balloon so that they make interest twice. So it works out for them. They make even more money themselves, but you cash flow at a higher rate throughout the 60-month term and still utilize the appreciation to pay the interest on the back end. So yes, to answer your question though, yes. It has to be a fit for both sides. So if you have an equation where you have an investor who wants to beat the bank, because an investor, if they love a property, they can just go to the bank, like, here's 20% down. And they'll say, okay, here's 80% at 6%, 7%, 8%. If it cash flows, it cash flows. All right, that's great. Like that is legal. That's a way to invest in a property. But this is a way that is also legal. You could put 10% down, 5% down. You make the terms. You're creating the terms with the seller.
Yeah.
I've seen deals where people have put $0 down in exchange for a larger monthly payment, in exchange for a larger interest rate, because everything can be manipulated. Everything's negotiable. So if someone says, I'm an investor, I have 20 investment properties, but I want to sell this one, but I'm filthy rich. I don't need the money. I'd rather make this a better investment because I'm a great investor. So don't even worry about a down payment, but I want 4% interest instead of 2%, and I want 2% deferred interest to the balloon, and I want it on a 7-year term. So by the end, I got a nice big payment at the end. Okay, that could still be a fit for the buyer because now they're getting they get a property for free. Nothing out of pocket, they're in the property. The tenant that they get to go in there, their revenue will be able to pay that increased monthly payment plus operating expenses and still cash flow. So now they own a property for free that's in their name, deeded in their name. They cash flow on it, they earn a certain amount of equity, they structure it so that at the end they can refi and then they still own the property, keep it as a buy and hold, or pay the buyer out or the seller out. Either way, it is structured in a way that was more advantageous for the seller because they didn't need the money. If someone needs more money up front, all right, maybe instead of a 5 or 10% down payment, I give you a 15% down. I don't want to give you 20, or I might as well go to the bank, right? But if I give you 15% down, then I'll lower the monthly payment a little bit. That way, sure, I'll sacrifice a little bit more upfront, but then I will make more every month for the next 60 months. That's how it'll be advantageous for me. So it's a give and take. And sometimes in these deals, you have to rob Peter to pay Paul, right? But I can manipulate any deal to make it work if I know exactly what is most important to a buyer and seller. I can always manipulate a deal to make it so that it'll be a fit for both sides, as long as the property value works out.
One question online.
Sure.
Usually, which type of buyers agree to these kind of deals?
So in fairness, the vast majority of the time, it would very likely be a real estate investor because they are looking to increase the size of their portfolio, and they're looking to get as advantageous terms as possible for themselves so that they can buy this property and then go buy 10 more, right? So back to what I was just saying, and I'm sorry, I never got your name. Which one?
Deepak.
So Deepak, we were talking about how, well, there's an option to put 20% down and go to the bank. If you do that, well, now I just spent 20% of my capital and I might not be able to go buy the property down the street. But if I gave 10% to you and then came to agreements on a 10% term with someone else for the same price property, I now have two assets that are both cash flowing, and I can replicate the process. So to answer the question, the vast majority of the time, it's probably going to be an investor that is looking to invest in more properties. However, I would also say that while when I first bought the house that I live in right now, I used a conventional mortgage because I didn't know anything about this stuff. Now that I do, if and when I ever do sell my primary residence, I will 1000% look to do a deal like this, even for my primary residence. Because I know for a fact I will be able to beat the bank on whatever rates they're giving. I will be able to put together a more advantageous scenario somehow. So I'm paying less out of pocket upfront and monthly and still own the property at the end of the day. So this absolutely can be a owner occupant scenario. So that's why if you have a buyer who thinks I want to look to go buy a house to live in, so that means I need to come up with 10% down. I need to come up with 20% down, whatever. You could tell them like, hey, if we find a seller that is interested in seller financing, we might be able to get you into a property for less than that. And it could be an option. But again, to kind of reiterate what we were talking about earlier, that also means that with the bank not being involved, you have legal instruments and documents between the buyer and seller that are holding the deal together with the title company. So there's very likely a lawyer involved to make sure it's all buttoned up and everything's all good. But you don't necessarily have the bank to foreclose on a mortgage, I guess. But either way, it can still be very advantageous for someone who'd want to do an owner-occupant scenario.
Yeah.
Are there any more questions online, by the way, that I might be missing? Because I'm not even looking, so.
I mean, good credit, have money and stable income. However, somehow they are not able to buy. However, most communities have FHA restrictions. That was a statement.
Can you say that one more time?
Hi, this is Ruby. Let me get that to it. So I'm trying to figure out which type
I
of
can't hear.
buyers.
Is this supposed to?
Is this
Hold on
good?
1 second for people watching me. Hold on.
Go ahead, Ruby.
Okay, so I just wanted to know the kind of buyers who would get into this kind of deals. Is one of them whose credit is good, everything is good, they can buy, but because of lot of communities have FHA restrictions and they cannot somehow get a conventional loan because of the higher taxes and association, which is all over the place in New Jersey. Can these people be uh, buyers, good buyers for these kind of deals?
I saw some talk over there. Okay. All right, yeah, so thank you for the question. So potentially, yes, and yeah, I know there are
Can you
FH.
repeat the question first?
Yeah, so the question was if you have a buyer who has good credit, he was talking about FHA, so this must be a first home buyer, right? So a potential first home buyer, good credit, good scenario, but there's a lot of FHA restrictions. There's extra, not fines, but extra fees and stuff and whatnot. Would this potentially be a good solution for them? While I recognize that there are a lot of potential issues with FHA restrictions in New Jersey, if they have good credit, meaning they're qualifying for FHA, FHA would likely be the best scenario because you're already getting the most advantageous interest rate that you can get and a very low down payment on that conventional deal. Then, I mean, other than a VA that might be 0% down or zero interest, the FHA loan program is in place almost to give a conventional stature for creative financing. It's basically creative financing. So I think that the best answer to your question is that they should probably utilize the FHA financing if they can find a location that doesn't have the restrictions and it meets their standards. But if they find a place that does have restrictions and it does have restrictions, but it's exactly the place they want to buy. It meets all of their standards and everything like that. Then yes, there's no reason why they couldn't do something like this, especially if they have a good credit score. What I guess I don't know the answer to off the top of my head, I'm going to assume that if you purchase a property, even if you purchase it in a creative finance vehicle, I'm not sure that you can qualify for an FHA loan again, like if for your second property, if you were to move somewhere else, because technically you've already bought your first home. You just did it unconventionally. I'm not 100% sure about that. Maybe it is once you conventionally use FHA or conventionally buy something, you can't do FHA again. I'm actually not sure 100% on that. But either way, I would say try to use the FHA because it basically outlines the deal structure almost identically to what creative finance does. It's just most people can't do FHA because they've already bought a home, right? So I would utilize FHA if you could, unless there is just a spot where the restrictions and the potential fees, association fees, whatever it might be, are so high that it disqualifies them, then yes, then theoretically this might be a good structure. But if it's a place that has FHA restrictions, there might be that might be like a place that has an HOA. There might be other barriers to seller financing. But again, I'm going to email this presentation out. My contact info is on there. If you have a specific situation, if this was a hypothetical you thought of, then hopefully my answer was okay, and I'm happy to keep talking to you about it. If you have a specific buyer that is in this predicament, then I'm happy to look at it with you and just figure out what would be the best scenario or the best game plan for that particular client. Because again, FHA is in place to craft a conventional mortgage almost exactly like creative finance is crafted for people that can't get an FHA or VA loan. So
One question, I know
Thank you,
VA
Dave.
assumable and FHA are also assumable. So if the buyer qualifies, they can assume that loan, then it's very easy. But all the like a conventional loans, they are not assumable. Is that correct statement?
that is a correct statement. And this is where the difference between subject to and maybe my opinion of not really venturing too far into subject to because of the little bit of gray area, right? This is where it wipes out the gray area. If you find a property that has an FHA loan or a VA loan on it, that your buyer can get approved by that bank, which is a very easy process to do nationwide, then that is a home run scenario. Because yes, it is assumable. Yes, the bank is made aware. Yes, there is transfer paperwork done. The mortgage now goes into the buyer's name. The seller does not have the disadvantage of the mortgage staying in their name, even though they leave the property. So yes, that loan assumption scenario with FHA or VA loans is another section of creative financing that is very advantageous, especially for investors.
What happened to the terms of the condition of the loan? Like if it's 5-year-old loan, you have paid almost 50,000 in the loan. So the new buyer has to put additional 50,000 so he can assume the mortgage because that mortgage is going to left now 25 years instead of 30 years. It doesn't reset, right? That's the only purpose of doing that, assuming the mortgage.
So they wouldn't necessarily owe the seller, in your example, they wouldn't necessarily owe the seller the $50,000 they've already paid. Because remember, they paid $50,000 to live in that place for 2 years. That was their cost of living for 2 years, right? So they don't necessarily owe that $50,000 to them. As far as the bank is concerned, yeah, we have 5 years of our 30-year term has been taken up, but it's paid, it's up to date, everything's all good. And then this new person is going to come in and carry along with those payments in the same manner. We're all good. We still agree to these terms. And as long as they keep abiding by those terms, we're fine. We're fine with it. So So yeah, you could take over and assume those type of loans without going into the trust, without having the beneficiary designation of subject to. And you could also at the same time get into, if you're the buyer, a loan at a low interest rate that you could easily make the payments on and become a great investment. Or once again, this can be an owner occupant situation. So an owner occupant could assume a VA or an FHA loan. At the end of the day, the VA wants to make sure they get paid. FHA wants to make sure they get paid. If they get paid, they're happy. And if they can transfer that into someone that they will probably, that they do some sort of a credit check just to make sure that that person is qualified to take that loan over. But as long as they are, then they're happy to transfer those loans because they are assumable. So that was a long way of saying, yes, you are exactly right.
Any other loans are assumable other than these two?
VA and FHA are the only two assumable loans in the way that we're talking about right now. Where the bank would be notified, I want to transfer my loan from person A to person B. They say, okay, person B, just fill out, it's a one-page form. Fill out this form, name, social, they do a soft credit check, and they say, okay. It's like a pre-qualification from a bank instead of a pre-approval. So yes, but then after that, no. Regular conventional loans, and then anything past that from the bank would not be assumable. And there's a reason why they make those assumable, because they're very affordable. A lot of people would qualify for them. So that it's basically like them saying, we'll throw you a bone. If you want to have someone else take over your payments, that's fine. It's a low interest rate thing anyway, no big deal. That's why they're okay with it. Okay?
Yeah.
Cool.
Yeah. Hey, it's nice to meet you, Mia.
All right. I think this was a pretty extensive spotlight session that we've had. I do appreciate Dave for all the information. I was running back and forth, but I was hearing the gist of it. I was, running back and forth to the office. So this was awesome. If anybody needs more information, feel free to reach out to Dave. He is now one of our associates. So you guys can definitely you'll see him around the office. You'll see him at our events. You'll definitely see him on another spotlight that we'll do to keep you guys, informed on what's going on with these types of programs and things like that. So I do appreciate everyone coming on. Dave, if you can drop your information in the chat so everyone can
Yeah, you know what? If it's helpful, like I could just the first page of this
Oh, yeah.
presentation, I intentionally put my contact info.
Okay.
So I can email the presentation to you if you want to disperse.
There we
it
go.
out to- You can disperse it out to everybody.
That's perfect. Okay,
Yeah.
so we'll do that. So I'll have the presentation, and if you want it, I'm charging $20 a head, okay?
Yeah.
$20 to get you the presentation plus Dave's information, all right? I take PayPal, I take Cash App, I take Venmo, okay?
Lawrence.
All right, you guys have a great weekend.
Lawrence,
All right,
it
guys.
seems like
Thank you
you're
so
not
much
selling
for everyone that
homes,
joined.
now
Thank you so
you're
much.
Thank you,
Have a good
everyone.
one. Bye.
Bye.
There you go.